Now, one thing that some people miss, especially those just getting started, is that you still have to actually pick the investments. Okay. So if you just transfer the money into your RSP, you're actually not done.
So, in today's episode, we're breaking down how RRSPs really work and how to choose the right investments for you to put into that account. As a reminder, today, Cornell and I are not providing any investment advice, investment recommendations, or tax advice. Today's show and all our shows are about investment education for Canadian investors. To help us break down what RRSPs are and how to make them work for you is Cornell Schreiber with Build Wealth Canada podcast. Cornell, it's so great to have you on the show with us today.
Hi, Danielle. Thanks for having me back.
Cornell, let's start a conversation for, beginner investors. What is an RRSP account and how can investors use this effectively to grow their long-term wealth?
Sure. So an RRSP, it's a tax sheltered account. I like to think of it as a tax sheltered bucket. It's not an actual investment per se. And you can put almost anything inside it, whether it's stocks, bonds, ETFs, even cash if you want. Although I'm not saying you should put cash in, there's better ways to do that. But I mean, it's quite of a flexible account. Now, when it comes to the RRSP, there are, I would say, two huge benefits, two major benefits. The first one I'll call tax bracket arbitrage. And so let's use an example. Let's say you're earning $100,000 a year. Well, in that particular scenario, you're paying over 30% as your marginal tax rate, give or take. Now, when you retire, it's actually quite easy to be in the lowest tax bracket. And so your marginal tax rate in retirement, it's likely going to be under 20%. So basically, what you can do is you can put money into the RRSP now. And instead of paying that over 30% in tax right now, you're now actually paying nothing temporarily on that amount. And then that amount will actually grow and compound. And then when you retire, you pay that less than 20% in tax when you actually take it out. So that's a really large benefit. And that's why you can probably tell. That's why I call it kind of like an arbitrage. Now, while it's in the RSP, the other big thing to remember is that your investments, they actually compound tax free. So let's say you have the investments, let's say you buy an asset allocation ETF, like a ZEQT, for example. Well, over time, over the decades, that is going to be growing. Now, while that's growing, you're not paying tax every year on that growth, right? So that's a way that you can kind of defer the taxes in that way. Also, that dividend is going to be paying out that dividend. That ETF is going to be paying you dividends as well. And just like with the growth, you are not getting taxed on those dividends every single year. So, for example, if you were using a non registered account, also known as a taxable account, well, then every single year when you get dividends, you're going to have to report that and you're going to get taxed on that a bit. But in the case of the RSP, you actually get to defer that taxation. And so that gets to compound, that gets to grow. And if you have bonds in there as well, well, they're going to be issuing some interest as well. And same thing applies there. You're not getting taxed on that interest every single year like you would be in like a high interest savings account. It stays there, tax shelter. And then so you're able to get that compounding to work for you in a really nice and efficient and tax effective way. So it's basically a really, really powerful tool to be able to defer taxation and let your investments compound at kind of the maximum amount. Now, one thing that I will mention that some people miss, especially those just getting started, is that you still have to actually pick the investments. Okay. So this is a critical mistake that I've heard some people make, in particular beginner investors, people that maybe haven't been nerding out about this like you and I have for quite a few years, Danielle, right? So if you just transfer money into your RSP, and this applies to TFSA as well, applies to FHSA, all these different accounts, right? They're just buckets, right? So if you just transfer the money into your RSP, you're actually not done. You have to actually go now and invest that money into something like an asset allocation ETF. If you don't do that, it's just going to sit there as cash, which is very inefficient use of your money. And it's actually going to lose money over the long term because of inflation, right? So you actually want to have that money invested. So don't forget that one important critical step. The other thing that's important to mention is the contribution limits. So there are limits to how much you can contribute to your RRSP. And the easiest, best way I would say to find that is look at your notice of assessment from the CRA. So when you file your taxes, that actually shows up. It's in one of the first few pages at the very front that you're going to see that. It's going to say, your RSP contribution limit is going to tell you right there. That's right from the government. That's a good source of information for you. And then current annual contribution limits, we should mention those as well. So for 2025, basically what the limit is it's the lesser of 18% of your 2024 earned income or $32,490, whichever one is less. Plus any unused carried forward room that you have. So basically, if you didn't max out your RSP in previous years, that actually continues to carry forward. So you can now, so let's say you missed last year or the year before, whatever the case may be, that amount actually gets added onto this year. So you can actually you can do more. But the most that you can put in for this year in particular, not including that unused room, is that $32,490. And then, like Danielle mentioned in the intro, the deadline is March 2nd, 2026. And so, just to clarify, that amount is basically if you want that money that you're investing to count towards your 2025 tax year. So right now, as we're recording this, it's February 20th, 2026. You have until March 2nd. And then if you put that money in before then, you can have that be attributed to your 2025 tax year if you want, right? You have that option. If you miss it, like let's say you're listening to this and it's already March 5th, you missed the deadline. Okay, well, you can still contribute to the RSP. You still have that room, but now it's going to count towards your 2026 taxable income, right? It's not going to be toward 2025 anymore. So that's basically how it works.
Great. An amazing tool at Canadians' fingertips, really growing wealth tax free, getting that tax credit in years when you contribute, and then punting that tax bill down the road to when you're hopefully in a lower tax bracket in your retirement years. Cornell, you mentioned a super point. You can make your contribution, and making that contribution before the March 2nd deadline, it really is just you transferring cash contribution from your checking or savings or whichever account into that RRSP account. But once you make that transfer and that cash is sitting there, you really want to think about investing it to make it work for you. So, Cornell, what can investors think about when they have that contribution made? How can they put that to work, and how can they make sure the investments that they choose are suitable for them?
Sure. Yeah. So there's, I would say, two really critical elements. The first would be the time horizon. And so let's say you're in your 20s, 30s, 40s, so you've got probably decades until you retire, most likely. And so in those particular cases, what I like to suggest is to really take on as much equity as you can actually handle. And that being able to handle it is a very important part because, we've had things like COVID, right? Where the equities fell across the board by like 30%, depending what you're invested in, right? And so if we're going to have situations like that again, hopefully it's not a COVID scenario, but we've had financial crisis before, the tech crash. I mean, things have happened. They will continue to happen. Crashes are going to happen in the future. Just assume that they will. Even though we've had a really nice market over the last while, but we have to be ready. And so you do, I would say, want to put as much into equities as possible. But you don't want to put so much that when we have, let's say, a 30%, 40% drop, that you start freaking out, you think the sky is falling, and you start selling everything off, because that's basically you're just eliminating that growth. You're locking in that growth, the loss essentially at that point. So it's something you want to be really, really careful about. Now, let's see, the if you are getting kind of close, like let's say you're retiring soon within the next, let's say, 5 years. Again, it kind of depends on your risk tolerance as well. But then things can change a little bit. So if you're retiring within the next, let's say, 5 years, you can switch to something a little bit more conservative. So instead of something like ZEQT, which is 100% equities, maybe you want to switch to something like ZBAL, which is 60% equities, 40% fixed income, right? And so you have a lower expected return over the long term with an investment like that compared to like a ZEQT, which is 100% equities, but you're going to get a lot less volatility, right? And so that's kind of something that you have to decide for yourself is how much are you willing to let your investments fluctuate when you're getting close to that retirement age. And so what I like to do is you could look at historical performance and say, okay, let's say when COVID happened, if I had a 60-40 portfolio, how much did it drop? How did that look like, right? Versus like a ZEQT, 100% equity portfolio. How did that look like, right? And so you can kind of gauge by looking at historically, okay, if I had this much invested and it fell 30%, versus like a Z con, let's say, or something different, how is that going to look, right? And then you can sort of decide what you think that you would feel comfortable with. Another strategy that you could do instead of switching to like a more conservative asset allocation ETF is you could do something where you say, okay, I'm going to do ZEQT, which is 100% equities. And let's see, even though I might be retiring soon, I'll still do ZEQT, but that ZEQT is intended for my longer term cash needs and retirement. But for the short term or maybe midterm, I'm going to go for something more conservative that doesn't fluctuate as much. And so that could be a whole bunch of different things. Maybe you can get a really good rate on a high interest savings account or a GIC. Maybe there are some short term bonds that you like, or money market type of ETFs, right? So like ZMMK comes to mind, things of that nature. And so that's another option where, okay, you can still do an all equity asset allocation ETF, but for that short term bucket, you've got some more less volatile investments so that when it's time to, pay the credit card bill, to pay for your groceries, to pay for your property tax, you're not freaking out because the market just fell 30% and now you have to sell because your property taxes are due tomorrow, right? So you do kind of want to manage that. So the time horizon, I would say, is a very, very important critical component, as well as your risk tolerance in general as well, and how much are you willing to let things fluctuate. The other really critical component is the investment cost. So here I'm just going to flat out say that if you're paying anything more than 0.2% MER, I would strongly look at that with a gigantic magnifying glass and really question, am I getting the value? Because I would be willing to bet quite a bit of money that you're probably overpaying if you're paying more than 0.2% MER. So asset allocation ETFs, typically they are about 0.2 percent right now MER. But in Canada, we have some of the highest mutual fund fees in the world. So I mean, I've talked to people who are paying over 2%, right? And then they kind of see the light and they're like, oh shoot, okay, how do I switch to an asset allocation ETF? Because that's such a, I mean, it's not like you're paying a little bit more. You're paying multiples of that particular, of what you could be paying with an asset allocation ETF. And what that really it might seem like small percentages, but because it compounds and because it's a percentage of your investments, that literally translates to hundreds of thousands of dollars potentially over your investment lifetime. I mean, think of what you can do with an extra hundreds of thousands of dollars. I mean, it's an enormous amount, definitely worth your time. We're not talking about like clipping coupons here where you're saving $1 on cheese or something. Like this is, you know, like very like I mean, this is like sending your kids to college money, right? Like this is very significant amounts. So definitely worth, I would say, in terms of like your ROI on time invested, this is very much worth learning about, especially if you're paying anywhere over 0.2%. And I mean, whoever you're invested with, they do have to legally disclose what they are actually charging you in terms of MER. So this is not something that it's like hidden and impossible to find out. They have to provide this to you. So definitely a project for you to look into. Everybody should know what MER they're paying. 100%. The one kind of caveat before we move on that I will say is when it comes to the home buyer's plan. So, like I said, typically RRSP is used for longer term investing for retirement. And so I try to make that as high into equities as possible due to their higher expected return compared to bonds. But in the case of the home buyer's plan, the time horizon shifts a lot, right? Because you're no longer needing that money in 30 years, let's say. You're actually needing that money maybe in the next 5 years because that's when you want to buy a house. And so in those particular situations, it makes more sense to do something more conservative, like ZMMK is one that I've used before quite a bit, because you actually don't want that. You don't want to be in a scenario where, okay, you found your dream house, you're ready to go, you've got enough for the down payment, all the ducks are in a row, things are good, and then the market drops 30%, and you're like, oh wow, okay, well there goes all that money. Now I can't have that house anymore because I was too heavily invested in equities, right? So again, once that time horizon gets shorter, like I would say 5 years or less, you really want to think about, okay, what are those cash flow needs that I have from now until 5 years? Because you want to actually account for that, because you have to realize that that 30% drop or 40% drop could come at any time. And I mean, long term, if you're an all equity or if you're an index investor and you just sit on it, historically, it has always recovered over time, but it's taken, 2 years, 5 years, depending how you calculate it for that to happen. So you don't want to be in that situation where you're ready to buy this house and you're like, oh shoot, now I have to wait 2 years or 3 years for my investments to recover, right? Well, maybe by then, you don't want to wait that long for your dream house. Right. So that's the one kind of caveat I will mention. But yeah, I hope that helps answer the question.
Totally. And time horizon is critical for investors to determine for themselves to decide, okay, am I going to be investing in equities? Equities could have a potential of more long-term growth, but any given year could drop 10-20%, like you mentioned during the pandemic, and then shifting over to fixed income if with a shorter time horizon for more stability. I also like what you mentioned about thinking about your RSP account in sleeves. So perhaps I just graduated university, I have a long time horizon, I want a lot of equities for growth, but I'll have a cash sleeve or a money market sleeve for a first time home buyer within that account. So many great points. Let's talk a little bit more about using ETFs in this account. So you mentioned it earlier. You talked about the benefits of low fees, but let's dig into that even a little more. How come investors should be looking to using ETFs in their account versus just buying straight up stocks or other investments?
Sure. Yeah. So, I mean, full disclosure, in my RSP, it's literally all ETFs, all just total market index ETFs. I've researched this to the extreme, as my wife would say. And so, yeah, I mean, after all that, the conclusion is it's definitely just all total market index ETFs. And then it just becomes a question of, okay, well, what would you like that allocation to be? A lot of times, between stocks and bonds, that kind of a thing. But when it comes to, how do these ETFs work in an RSP? How can we use them? Well, for anybody new to this, investors can just buy ETFs in the same way that you would buy a stock. It's the same kind of process. You basically have like I mentioned, some tickers already, like ZEQT, ZGRO, ZCON, ZMMK. You put those in within the brokerage, and you're able to buy units of that particular ETF, just like you would a stock. Now, the big difference, though, versus something like a stock, is that typically when you buy a stock, you're just buying well, you're just buying one company, right? Like I'm buying Amazon stock. Okay, so that's just one company. So by definition, that's very much not diversified, right? It's a single company. Whereas if you buy an ETF like a ZEQT, well, that literally has thousands of companies in it across the entire world. So think of ZEQT as kind of like a bucket, and it has thousands of companies in it. And it's basically meant to represent the stock markets across the entire different stock markets across the entire world. So just with this one ETF, this one investment, you literally have you're basically fully diversified worldwide. I would argue you're as diversified as you'd want to be from the equity side with something like a ZEQT. So the complete opposite of basically buying one individual stock. So the whole definition of not putting all your eggs in one basket, definitely with ZEQT, something like that, like an all equity asset allocation ETF, you're very much not putting your eggs in one basket. You're extremely diversified, and that's, I would argue, what you want to be as well. The other thing that I wanted to mention is this growth tax shield. So when you have the ETFs in your RRSP, those are going to be there's going to be stocks in there. So those are going to be issuing dividends. If you have bonds in there, it's going to be generating interest as well. And there's going to be growth as well on these ETFs. And so basically you've got three things. You've got the dividends, you've got the interest, and you've got the growth on the actual investments, how much they're worth. And so as these things are working for you and they're growing, you actually do not pay you pay zero tax on that growth, and you pay zero tax on that income in the form of dividends and interest, as long as it stays within your RRSP account. And so what this allows you to do is it lets your money compound much, much quicker than if it was in just a regular taxable account. So that's one, I would say, critical component that you want to mention. Because if you hear someone say, like, I've heard this before from people not really familiar with RSPs and how they work. They'll say, like, "Oh, I'm not going to bother with an RSP. What's the point? I mean, yeah, you save money on tax, but then you got to pay the tax back. That's totally not worth it, right?" Okay, so that's totally wrong because we already talked about the whole arbitrage thing about the tax bracket arbitrage. That's a huge benefit. But then the other big benefit, again, it is this whole piece about you're basically able to defer taxation. So your investments are growing, they're compounding, and they're not getting touched by tax at all until a much, much later time. So you're basically dealing with a bigger pool of money because it hasn't been touched by the government in the form of taxation. So, I mean, that is huge. The other thing that I want to mention about asset allocation ETFs and just using those instead of like a stock is that, well, I already mentioned they're globally diversified. The other big thing is they're automatically rebalanced, which is huge, right? And so that can, from again, I've been running the Bill of Canada podcast now for over 10 years. And that's one area where people get kind of hung up on going from these high fee mutual funds to becoming DIY index investor through ETFs. Is they're like, oh, shoot, I have to rebalance. How do you do that? Maybe I'm not good with spreadsheets. all these calculate. I haven't done this kind of math since like high school, and so it becomes like a point for them that they don't want, and they're busy, right? They don't want to have to deal with it. Well, with asset allocation ETFs, they're automatically balanced, so you don't have to worry about that at all. And like I said before, they cost a fraction of what a mutual fund typically charges in Canada, so you're saving on that side as well. And then, yeah, just the one caveat I will mention as well, if you are using ETFs to invest in your RRSP, and this applies to individual stocks as well, is don't forget to actually reinvest those dividends and that interest, right? So what you'll see happen is you buy these ETFs like a ZEQT, ZGRO, whatever you choose to do based on your asset allocation. Well, those are going to spin off dividends and interest for you over time. Now, if so, you're going to actually just see cash show up in your RSP account. Just it's just going to show up. Like depends on the ETF that you choose, but typically it's every quarter with the ones that I'm in. And so you just see this cash show up. Well, don't forget to actually take that and use that to buy more of that ETF, right? And so that way you get that compounding effect that I'm sure people have heard this already, the whole magic of compounding and how it really helps accelerate your wealth. Well, this is actually how it works, right? They spin off income and then you get to compound it by reinvesting it. So that's something that definitely you don't want to forget.
I call those my soldiers every time
That's
get
right.
in
You
my
want to put them to work. Yeah.
Put them back to work because remember, like what you said right at the beginning of the episode, your cash will devalue if you don't invest it. The purchasing power will devalue if you're not investing it.
100%.
And those soldiers that you're getting in dividend income or interest income won't be taxed again, as you mentioned, Cornell, until future years when after it's grown and compounded. Very, very powerful wealth creation tool. Let's talk about the deadline. You mentioned March 2nd. And can you just remind us, how does that deadline work for the 2025 taxable year?
Yeah, so March 2nd is the deadline, like you mentioned, March 2nd, 2026. And so that's if you want your RSP contributions to count towards the 2025 calendar year taxes. Okay. So that's basically the deadline that you have. Now, when you're doing your taxes, I noticed actually on the form, or if you're working with an account, you can ask them about this, but you can actually specify what year you want them to apply to, right? So if I'm investing like in January right now, like February 20th, you can say like, actually, no, I want them to apply to the 2026 calendar because maybe, you're doing some tax planning, maybe you're going to have a lower income year this year, you think, so maybe you want to do that. But I would say for most people, the year has closed on December 31st. Now it's, January, February, and they're thinking, okay, I want to get some money back for the taxes, right? And so I would say the overwhelming majority of people, the process is you put in money, before March 2nd, and then that you make that apply towards your 2025 calendar year. So that's kind of, I would say, like the default that you have. Now, typically, just so you know, for future years as well, the way it works is typically you have 60 days of the new year to have it count towards your previous year. So I haven't done the math, but like March 2nd is roughly 60 days, since the beginning of the new year of 2026. So that's typically how it works. But what I usually do is, once the new year starts, the government basically publishes information saying, hey, Canadians, here is the actual date that you need to follow if you want the RSP contributions to count towards the year that just ended. So this is the deadline. So basically, once a year, like in January, I'll Google it, get it right from the CRA website, and it just shows you the date right there. So that's kind of like the fail-proof way where you're getting the information right from I say this respectfully, right from the horse's mouth, and then you know exactly what it is every year. But yeah, for this year, like you said, it's March 2nd, 2026.
And to be clear, when you make that contribution, what it does is it lowers your overall income earnings for that calendar year, and that's why you get that credit back. That's kind of how it works from the CRA perspective. I like that you highlighted about thinking about the year you take the tax credit in, because from my perspective, uniquely, I was on maternity leave in 2025, so I had lower income, so maybe I might consider punting my contribution to 2026. So there's an example how you can kind of play with it to get the most out of that tax credit.
Yep,
Last
for sure.
yeah, lastly, Cornell, I want to talk a little bit about your own personal experience with using an RRSP to kind of reach your financial and retirement goals. So, for those who don't know you, you are considered part of the FIRE community. So, financially independent, retire early. And how did you use your RRSP to get to that, those retirement years much earlier?
Mhm. Yeah, so we hit our retirement number when I was 32. I'm 41 now, so it's been quite a while. But yeah, what we and then so yeah, so these days I just run the Build Wealth Canada podcast. That's basically, and then so that makes some money as well. But so depending on your definition of retirement, I'm either fully retired or semi-retired. Again, depending how different people call it different, define it differently. But yeah, to answer your question, the way that we used it is, well, one is we maxed out our yearly contributions. So back when my wife and I had regular jobs, we basically would max out our RRSPs to that maximum amount that I already mentioned out earlier. And then the other really important critical thing is that any refunds that we got from the government after contributing to our RRSPs, we invested. So that's the really big thing, right? Is in order to actually get the most use out of this whole tax system, this whole setup and RSPs and how they work, you don't take that refund money and go on vacation with it. You actually invest it. So that's the thing. Because if you don't do that, then honestly, you're better off just investing. Like if you don't have enough money to max out TFSA and RRSP, then you're better off just maxing out your TFSA instead. If you're not going to be reinvesting that refund from your RRSP. So I would say that's a really, really critical component, and that's what we did. And then yeah, so if you're trying to retire early, like in your 30s or 40s, like basically to do what I did, then typically what ends up happening is in order to hit that investment number in such a short period of time, you basically just need a really high savings rate. I mean, ideally, like higher dual income, high incomes, ideally, right? And then saving as much of that as possible. And then taking that money and maxing out your RSP contributions, maxing out your TFSA contributions. And then once those are maxed out, you still have some money left over. And then you put those into the non-registered account. So I'm not saying everyone's gonna want to do this because like it obviously takes quite a bit of sacrifice and work. Because like in my case, we basically lived off one income for like somewhere around a decade. So we would just one income was to pay for everything, the other income was invested, right? Like that's the path that we took, and obviously that's not for everyone. It takes quite a bit of sacrifice and things like that. Um, but that's basically what you do is if people that want to retire early, you're basically maxing out the contribution room for both the TFSA and the RSP, and you still have to put in even more into the non-registered account in order to hit that number that quickly. That's typically how it works. But for like the normal scenario, like the more traditional thing, a lot of people, they get something out of their work, like a pension, defined benefit or defined contribution pension plan, plus TFSA, plus RSP, and then they're good. That grows over time, it compounds, and then they're able to retire. So ours is kind of like an extreme example. The other thing we did is we made sure we had a super high equity allocation. So, like I mentioned already, stocks have a much higher expected return than bonds. So again, if we're looking for like what kind of things did I invest in, it was basically all equity, right? So like ZEQT was kind of the example I would use. That's basically how we pulled it off. So again, we have to be very comfortable with the volatility because yeah, like we had COVID, right, and we had our portfolio drop by hundreds and hundreds of thousands of dollars when COVID happened, right? And I mean, it shot back up afterwards. Things turned out fine, but at the time, like it's not fun. It's not a fun ride, right? So, but that again, those are kind of like the ingredients or the cards you play to hit that fire, the early retirement thing. Yeah, so that's one thing. Um, and in TFSA also we went all equities, and I do recommend that for most people because all your growth is tax free. So I would say if you don't feel comfortable being all equities, that's totally fine and that's normal. So I would use the RSP for that and use TFSA for all of your equities because that has the higher equities have the higher expected return, and so those can grow more tax free. So from a tax perspective, you're winning on that side. Let's see here, and then I guess the other one of the last points I want to mention is that if you are trying to do the whole early retirement thing, you don't need to invest in some risky, speculative fringe products, doing some crazy leverage moves, speculating on Bitcoin or whatever the case may be. Like in our case, we pulled it off like the boring way. You don't need to do some crazy investments. We just did total market index investing, like again, like a ZEQT kind of scenario. That's all that you need to do. And so instead of focusing on these like get rich quick things, which we totally did not do, instead, we focused on other things, right? So I focused on tax planning to make sure we pay the least amount of tax possible, right? So like using these registered accounts, we focused on maximizing any government benefits or credits that we were eligible for. We tried to maximize our income. So I had like a side business that was bringing in extra income as well. It was like a rock climbing business, right? So like just trying to make more money and then saving more money as well by controlling your expenses. And then by all those things together, we were able to hit that really high savings rate. and be able to retire early. So yeah, so those are, I would say, the different kind of cards we have to play. And again, I'm not saying it's for everyone, but that was sort of like behind the curtain look on the different levers that we pulled that helped us get to that point. And I think even if someone's not retiring early, some of those can still be pulled just to help kind of accelerate your net worth faster than it may be growing right now, just by making these minor adjustments, like tax planning and more inequities and becoming more tolerant with risk, things of that nature.
Right, disciplined savings. I know no one really wants to hear that, right? We just wanna know what stock can I buy
Exactly.
with
Yeah.
overnight? But guess what? Those don't really exist. They're hard to find. They're extremely risky, and your odds of losing your money could be probably higher than getting rich quickly. So that disciplined savings approach and, utilizing the tools that are available, like your RRSP, might not sound exciting, plain vanilla index investing, but hey, it worked really well for you, Cornell. So thanks so much for sharing all that insight.
Awesome. Yeah, thanks. Hopefully it wasn't too much, but I mean, I always find it interesting to hear how others have pulled it off, because even though not all of it might be a good fit for you, it's nice to know kind of what's on the menu, and then you can sort of pick and choose like, oh, I think this strategy would work well for us. I think this one would, you know what I mean? And you can kind of custom tailor it to how much you want to sacrifice versus live and spend, and then find kind of that sweet spot for yourself.
We're glad you didn't fully retire because it's so much fun to work with you on projects like this on our YouTube channel and visiting you on your podcast on Bilbo of Canada. So thanks so much again for taking the time today, Cornell.
Awesome. Thanks for having me. Yeah, this is a lot of fun. I don't know why, but for some reason I'm wired to really enjoy this stuff. So this is really this is really fun. And it's nice to give back because it's like it worked well for us. And there's so much things online where people are just like, like the get rich quick stuff and they're like speculative. And people are like, look, I have kids, I have a full-time job. I don't have time to research how to speculate on cryptocurrency. You know what I mean? It's like, well, look, you don't have to do that. Like you could just do index investing. And like I said, focus on tax optimization, focus on leveraging any like government credits or benefits that are available, right? There's all these different things. Focus on managing, maybe have like a little side hustle there's all these different things you can do. You don't have to do some crazy speculative, risky things. And then, yeah, like keep in mind too, like you only hear about the good stuff, right? When people make a bunch of money off some cryptocurrency, you hear about that because they're going to brag about that, right? You don't hear about the thousands and thousands of people who tried that and lost their shirt and now have to start over again, right? So you don't have to take that path. There is a much more gentler path, I would say, and that's what we took. So I hope that helps some people, or at least gives you some options on the menu that maybe you didn't know existed, and hopefully they're a good fit for some of them are a good fit for you, for the listeners.
Absolutely. Well, thanks again for your time.
Awesome. Thanks so much, Danielle.
And that's it for us at ETF Market Insights. We'll see you next week.